Come, let us prepare, make some good money this week. Now, midway in this video, I'm going to be explaining a very, very important concept that will improve your day trading fundamentals. So please stay tuned until I explain that main concept, as I am going to be using that concept to explain certain structures that we see in this macro chart right now. Now, just a very quick recap of what happened on Friday. Now, I was mentioning we have to be paying attention to this level on the ES. Now, if you have watched Friday's video right here where I talked about that spectacular bounce, take a look. It has happened again on Friday. Now, this has happened the day prior on Thursday. Pay very close attention to, take a look. Large bounce. Unexpected one, but right off perfectly of the 200-day moving average of the ES, and it happened right again on Friday right here. So if you have not watched Friday's video, please watch it here. Understand how we came about with this. Now, I also mentioned not to be cutting your calls until we clear the 5-day moving average for the SPY, and we never went under this 391 purple level right here for SPY on Friday, and there was no need to be cutting your calls here. So on Thursday, what we did was to swing some puts, expecting some sort of pullback. We had the pullback that happened on Friday with the gap down, took some profits off the puts, kept our calls open, and I said to take some calls. Why? Because we saw a possibility of a liquidity grab at 400, and that was just to be careful and to hedge our positions. In this case, if you took your puts profit because we bounced right off this 5-day moving average as well as the ES of this 200-day moving average. This is a very important level. Now, I'm going to explain a little bit about this concept. How did we understand this? And it's a very simple concept called equilibrium. I'm going to explain a little bit about that later in this video. Now, although intraday we had almost a 5-point day. Now, do note this is a 30-minute chart. You can see from the watermark at the back right here. Although intraday we almost had a 5-point day, most of it was from the pre-market gap down. We are technically only up about 1.5 points, and comparing the highs to the highs, probably less than a point. So this doesn't say much, although it's quite bullish, but we are still trading within a certain equilibrium and acceptance of price between the buyers and sellers. It doesn't tell you much about the trend at this point in time. Now, we take a look at the daily chart here, and this is what we need to be preparing ahead before all the major catalyst events ahead. Now, we are firmly still in this cup formation right here. We are in this buying channel that we see has started from the rally from this 380 range right here. And if we take a look at the cup, it is possible for the cup to end at this 410 level here, which I will talk a little bit later whether it will get there. And very importantly to note, you have to realize that we have very key resistances here. We have the upper Bollinger Band, which I explained. The upper Bollinger is a fluid indicator. This can continue to head up. So treat this as a trend indicator, not necessarily as a trade indicator, right? We have this macro selling channel here that everyone's talking about. I will talk a little bit about that later as well. Some hidden intricacies that you have to pay attention to. Now, it has been respected all the time, but this time might be slightly different. I want to bring out a very small detail and for you to be making your assessments from there. Now, we also have the 200-day moving average. That's a very key indicator, so we want to be looking out for that. And lastly, 400 is a very important trading range, about 400 to 402 level here. This may form the cup, and a certain pullback may be necessary in order to push us back out if a rally is to ensue. So at this point in time here, if you are looking to play puts, you cannot be calling the top yet, but you can expect some sort of pullback. And what does that mean if you're taking puts? It means that you do not go full port on this. You try to reduce your risk. You know that the market may have some pullback, maybe up to 390, maybe up to 5-day moving average. You expect some pullback, but you cannot be calling the top yet, because there are certain risks here. If you want to add in some positions later, if you're taking puts here in smaller positions, you can add on your positions later when it fails the 200-day moving average, when it fails the 5-day moving average, when it fails the 390 trading range. So you have time to head down. So there's no need to be calling the top here right now. Trade safely, trade wisely, use structure to try to understand how do you assess your risks. Now the market is very, very guided by catalyst events now. So I will be running through the key catalyst events ahead of us and what to be paying attention to. But at this point right here, where we are at the major resistances, an expectation of a pullback expected. But yet on Tuesday, what you want to be paying attention to is to see if there will be a stop hunt and a rejection of the level. Now there are a few signs from this. Firstly, the reclamation of the 200-day moving average. And this was a great play on Friday, in fact. Now, if you waited in the chop for a certain breakout and retracement, you would see this is a perfect retracement here into the 200-day moving average as some sort of flag. Now, this is the perfect breakout and retrace play. Now, if you waited for this instead of getting chopped here, so you should have set alerts. And once it broken out, wait for certain retracement. See if the retracement forms into a support, and in this case beautifully into both our levels, our ping 397 as well as the 200-day moving average that coincided perfectly. Is this intentional? Obviously it is, right? And this level just came to shine right again. We had controlled selling. Take a look. This is a controlled selling. Now if you don't understand what I'm talking about, I talked about this controlled selling right here in this bull flag, in this video right here. Please check out this video so you understand how to tell the difference between a head and shoulder formation as well as this controlled selling into a flag, bouncing off a very key support level. And you would have ended the week very strongly with an additional 2 points worth of profit right here at the close of Friday. But with every rally on Friday afternoons, it's not always convincing, especially when we broke out. We sprouted out of the buying ogles right here. So this may be very easily rejected because it's not a controlled buying. So do look out for this. That's the first thing I will be paying attention to on Tuesday when market opens, is if we do reject the range and trade underneath the 200-day moving average. Especially, once again, so many key resistance levels here. An expectation of the pullback possible, we have to pay attention to that. We are expecting a pullback. You have to be paying attention to key levels: 200-day moving average, 5-day moving average, 390 in the trading range right here. And I will be guiding members with these levels on what to be paying attention to on Tuesday pre-market in the Discord server. As I will always do at the start of the day, we'll be providing some guidance and pre-market levels right here. So Discord members, please pay attention pre-market on some of the key levels and the analysis we want to be paying attention to right here. Now, will you be surprised if we continue to push right up to 410 level here? And as I mentioned, you cannot be calling the top yet, because right now you'd have to respect the charts. We are in a buying channel here. Take a look at the 30-minute chart. On Friday, we carried on with the same buying algorithms as we did on Thursday and on Wednesday and on Tuesday. It's the same buying algorithm. Someone's buying. It's in a very rhythmic pace here with this buying algorithm. We want to be looking out for certain resistances before we decide there's a certain structure that we want to be headed down, especially when it's reclaiming all the major levels that we are paying attention to. We must not forget also of the trade indicators that we are seeing. In this case, if we remember the 5-day moving average trading above the 20-day moving average, that's an indicator of a certain uptrend. So we must respect that. So if you are trying to short the market, you have to respect this and don't go full port yet. You have to wait for certain confirmations before you add into more positions. You can obviously get into small positions here, especially with so many key resistances, but know where your take profits are in this case and wait for key indicators like this to trend in your favor if you want to be shorting the market more. Now, technically speaking, we can complete the cup here. This will be where the structure is fully balanced. It may take time to get there if all the catalysts are in place, and if the market conditions guide us to get there, it's still possible. So we cannot rule that out as well. You'll be telling me, Eric, how about this very large, strong trend line that we were talking about and everyone is talking about and has been respected since the start of last year and has always been calling the top right here. And now if you chart this level here, right, if I was charting this level, this particular trend line, and I charted a channel right here as well. And this helps you with a greater understanding of seeing how this particular wave here is not complete wave, right? Whenever we hit the top of the trend line, we complete a wave. That's wave 1. We hit another wave here, wave 2. We hit another wave here, wave 3. This wave is not even completed. It has not even went below the channel. And this just provides so much support in this level right here, this shaded orange level here. So if this trend line is not respected and we trade above it, it's very possible that we will meet with some resistance instead if the bears want to be taking control. And when you have some resistances here in a very controlled buying condition, if you remember, as I talked about, buying channels like that, just beautiful buying channels on the way up here. And what you will see is you will form a beautiful, beautiful bear flag here. So right here like that, right here like that, a beautiful resistance, even if we broke through the trend line here, because it's a beautiful buying structure on the way up, we will get a beautiful bear flag. And currently, although it may seem very bullish, not at all yet, you have to be paying attention to that. Just be sure to not just base your trades on a single line like that. You have to understand the macro structure, understand where are the possibilities the bears and the bulls may be waiting, and you can plan your trades ahead. And this is why swing trading, as you trade over multiple days, it's much more complex than trading intraday. And therefore, my suggestion if you're new to trading is to be looking out for intraday trades first, as you understand structure better, as you understand the concept of equilibrium, as you understand how to be planning your trades and assessing your risks. Now, as I mentioned, there are always trades to be taking intraday, always money to be made. And that's what we're doing in our Discord server. Every day, we're looking out for at least 3 trades, and 3 trades is all you need. 3 trades, take your profits from the day, call it a day. No stress to leave trades overnight, and you can sleep much better at night. And from there, you can also learn how to see structure, learn how to understand market risks, and from there, translate it into a larger macro context. And this is the concept I want to be sharing about, very important concept of equilibrium. Now, you will realize, for example, cup and handle on the daily chart. Why is it so much harder for it to form and materialize compared to when we have it in the 1-minute chart? And trust me, on the 1-minute chart, we benefited from this cup and handle so many times this past week, right? We had one here, beautiful cup and handle. Take a look, just beautiful. We saw this coming. We made some money off this. And even the day before, take a look, another beautiful cup and handle formation right here, right, that we break out here. 4-point profit, extremely lucrative. And you'll be wondering, this works so well on the smaller time frames. Why do we see such difficulty in just calling the top for this, knowing that it's going to form a handle and push it out, right? And that's the difficulty when we start to trade in a larger macro environment. Now, this concept of equilibrium is very simple. In the stock market, it's always about finding agreement between buyers and sellers. If you're buying something at $3.98, for example, you need a buyer who's willing to buy at $3.98 and a seller who's willing to sell at $3.98. Now, when there's a large amount of volume, it's very difficult for someone to agree on just one price. And that's where we have trading ranges and equilibrium. So, example, during this period of time, these 3 trading weeks, the market has agreed that there is a group of buyers, in fact, all of the buyers and sellers agreed to be selling and buying between 386 and about 375. So we have a small 10-point range where all the buyers and sellers have agreed on this equilibrium of a price. Now, this is a 10-point range here. Now, if you're a beginner trader, there is just very, very small chance that you have a stop loss for 10 points worth that you're willing to appetite this risk with multiple contracts, right? This is why you have to start from day trading, where you are just playing around 1 point, with half a point, with 0.3 points for your stop losses. And if you're playing on a larger time frame, when understanding a larger equilibrium, you need to be hedging your positions. And this is where concepts such as strangles, spreads, straddles all come in. And on a smaller time frame, because there is less volume in a 1 minute chart, for example. So for example, between 10:30 to 1:30 3-hour period for SPY, that could only at the most be 20 million volume, right? But when you take a daily chart, for example, and you see this cup that is possibly forming from the 12th of December until the 12th of January, I can tell you there's about 2 billion trade volume right here. Now, comparably with a 1 minute chart right here where there's only 20 million. Now, the concept of equilibrium is very simple. Now, is it easier to get 20 million people, for example, to agree on something compared to 20 billion? Which is easier for you to get a consensus from? Obviously 20 million. The less people there are, the easier it is to be finding consensus. And this is why on smaller time frames, you will see structures like a cup and handle forming that imbalance, and it works so much easier, so much faster. You get greater feedback compared to, for example, a larger time frame. Firstly, you have to contend with the larger range. More people means you're going to have a higher range of equilibrium for these amount of people to be agreeing on a trade price. Secondly, because of the large volume, it's hard for them to come into equilibrium. You will see structures taking time to form. And when there is a larger range, when there are more structures that appear, you will see multiple structures in a larger time frame, and thereafter it will be so much harder for you to be given the certainty that this particular structure is going to work. If I take a look at the 1 minute chart, for example, and at this point here right now, this is just a 1 point range, right? So apart from the cup and handle, what other formation do you see, right? Do you see a possible head and shoulder? No, it doesn't form, right? This head and shoulder doesn't form. There isn't a secondary resistance right here, although there is a very clear support. You don't see a head and shoulder forming, right? So it's very clear, and we have a very controlled selling here as well. So you see this cup forming. You know there's going to be some pullback because of this very strong resistance level here. You see the control selling forming, and you know that this is a bull flag as well, because we had a beautiful buying channel with some pullback back into a resistance. Sorry, I meant a support, and this will be your cup and handle that's forming. Do you see several other structures? Not at all, because the range is small and the consensus is quick because of the lower volume. But if you take a look, daily chart right here, if you break it down, for example, into a 30-minute chart, you will see so many structures within this particular cup that is forming, especially when you have trading ranges, when you have key levels in between them. So sometimes you have to be careful if you're looking at a macro structure and a larger time frame to be just focusing on structure like that. Practice on the smaller time frames so that you can understand the concept of assessing your risks and knowing where your risks are. And when you start trading on larger time frames, you can assess your risks. So in this case, if I'm taking puts, and it's a valid thing to be taking puts here, but you're not going to go full port here, and you will know where are your profit taking targets, and thereafter you can add in positions if it does continue to head its way down, form a new structure, head and shoulder, for example. So apart from knowing the trend, apart from knowing how the market is going to be moving, you need to plan your trade. You need to know your risks. And so trading on a larger time frame does have a little bit more complexity involved, but yet it's where the big money is, right? So you have to start understanding concepts such as hedging your positions, and that's where strangles come in, that's where straddles come in, that's where spreads come in, especially on larger time frames. And you need to start off from the smaller time frames as you appreciate structure, as you appreciate how to be planning your trades and understanding the concept of equilibrium and trade ranges. Now, catalyst events ahead. Wednesday, we have a PPI report. On the 27th of January, we have the PCE report, and obviously the blockbuster will be the FOMC on the 31st of January, and the press conference will be on the 1st of February, where Powell will be speaking. And so we have to be paying attention to all these events, as well as earnings season kicks off, and we're going to have a very exciting end to January. So on Tuesday, very simply, just another quick recap. Just pay attention to a possible rejection here, especially the 200-day moving average. Pay attention to the ES 200-day moving average. That's a very important level. Now, we are still in a buying channel here, so pay attention to the buying algos. I will be looking out for this particular algo on Tuesday and for the rest of the week. And Discord server members, I will be providing pre-market brief, including all the important levels and structures you have to be paying attention on Tuesday, so not to worry. Right, so thank you very much for watching. It's a slightly longer video, but I hope you find some value in that. So thank you very much. I will see you closer to opening bell.